In this next example, we're going to go over long-term trades. First, it's really important, just like on a short-term trade, that you choose the right time frame. You don't want to go too far back. For example, in this chart, we have the Euro USD, which brings us all the way back to about March or February of 2010. You can see the price movement. The low of the euro was 118.74, and we had an uptrend all the way up to 149.48. As a trader, you need to have an idea of what's going on today, as well as what happened and the reason why the price movement was, for example, at 149 and dropped all the way to 131. There's always a story behind the price movement, as we mentioned in the previous video. The story down here was because of Greece and having their debt problems. Soon enough, the government, the ECB, found a way to give the market some relief, which increased the value of the euro all the way up to 149.38. So we don't really need a chart that's going to bring us back to February, March, or April. We need something that will bring us back to approximately about 3 months to 5 months, giving us a view to the price movement. Why is that important? So we can put support, resistance levels, but now there's nothing positive about the euro or about Italy, which we feel that will overcome anything good or any positive numbers, and that's the reason why we feel that the euro will come down in price. But now let's take a look at the current price of 135.02. We have the lowest level, which was 131.43. Then we have the highest level to 142.50. We had changes in the Greek government as well as the Italian government, which forced the euro back up to 142. So this would be our resistance level. This would be our support level. Right now we're dead center, right in the middle of between these 2 points. What should we do? Well, because we don't think that the euro will increase in value in the long term, a couple of months from today, we obviously don't want to get stuck in buy positions, even though the euro can increase to 137, 138 on a good news report, for example. Any fundamental news reports can impact the market or the price of a currency anywhere between 200 and 220 pips in one single day. So therefore, if the price of the euro is at 136, it can easily go to 138 in a 24-hour period. So we can never say that the euro will not increase in value, because it can. But in the long term, we feel that the euro will come down in price. So how do we trade with this information? The hardest part is picking your points, where you're going to sell the euro. We obviously want to sell long term, but we're a bit far from the 142. If we were able to get the price of 137.50, maybe 138.50, that would be a good number to sell the euro, because we're far away from the session low, which is eventually the direction that we want to go to, and could give us a very good profit if Italy decides to give us some bad news about their economy or their government. So when you're looking to trade long term, remember, the most important fact is to choose a chart that gives you the story for the previous months. In this example, all we needed was a chart that gave us the story 3 to 4 months from today, just to give us an idea of the price movement. Therefore, we can figure out our support level and our resistance level. Notice our resistance level is not 149. Our resistance level was 142.50. That was the recent high before it started moving lower. And previous to that, this was the lowest level. Now this is something that's going to take time, and you're going to learn to interpret this information for long-term trading as you get more practice opening up long-term trades. The next very important factor is your contract size. You cannot open large contracts when you're going to leave positions overnight. Remember, in 24 hours the euro can move anywhere between 200 to 220 pips. That means that overnight you could be down 220 pips. What are you going to do then? If you place a stop of 50, 60, or 100 pips, you might get stopped out before the price starts coming back down in your favor, because you have 2 sessions that are going to trade while you sleep. So you have to trade with smaller contracts, giving yourself room, or the price room, to move when you're not in front of your monitor. When you're trading long term, we suggest that you give the price at least 200 to 300 pips, where, for example, if we sold the euro at 135, even though I know this is not the best possible price, but I entered at this level, I'm actually looking for 137. So if overnight the price goes to 137, I'm down 200 pips, but I'm prepared to sell a little more at 137. Therefore, I have to give myself room, and at the same time have a small contract, so in case it does go against me, I could place another trade and not over leveraging my account. So when you're trading long term, you have to trade using small contracts that can withstand 200-300 pips, and placing another trade at this level and maybe going another 200 pips against you. We know this is something that most traders don't practice unless they're trading for banks and major institutions. We will give you a simple calculation in the next videos so you can get a better understanding of the price movement and when the market goes against you 100-200 pips in dollar amounts. For now, the important part about this video is understanding, number one, to choose the right time frame where you can go back in time anywhere between 3 to 5 months. You want to have the point of view of what's going on today and what happened in the recent months, which brought us down to this current price. And when you look at a chart, you need to have your support and resistance levels, which will help you figure out the best entry if you're selling long term or if you're buying long term. And don't forget, we must ask ourselves the question, why do we feel that the currency will increase or decrease in value over the next couple of months? And that is the key to understanding the facts that will bring this currency to that price that we believe it will be in the months to come.